So in the last lecture, we had seen the different ways of recognizing income and the different stages of recognizing income. I think we have covered all the 5 steps in the last session, right? And we have taken the questions also based on all the 5 steps which are there. And we had done also performance obligations satisfied over time and at a point in time. So I gave you the example that suppose we are having a subscription to a journal, and that is for a period of 2 years, and you have paid say $4,000. So in a particular year, you can show only the revenue of $2,000 because we are having the performance obligations spread over a period of 2 years. So that income also should be spread over a period of 2 years. Okay, so same thing. Let us now come to income measurement. Income measurement, basically we are here learning as to how to match the the revenue with the expenses, matching expenses with revenue. So we are following the matching principle. Expenses which are outflows of cash, use of assets, or the incurrence of liabilities from delivering goods or services as part of normal operations. Expense recognition within the proper accounting period ensures that users of financial information can assess the cost of revenue earned by the company during the period and gives a more accurate analysis of the company's profitability. It means that when we are producing something or when we are rendering service to a client, what happens is we incur expenses, and after incurring expenses, the revenue is generated. So the best way of finding out the profitability is to find out to match the expenses which have been incurred to generate the revenue. Okay, expenses are necessarily incurred to generate revenue. See this, expenses are generally incurred for generating revenue. So without expenses, you cannot earn revenue. For example, you want to start a business. Let us say you become a professional person. You are giving let us say a tax consultant. Now you want to set up an office. You want to start your own office, where you want to do tax consultancy. Now in that, to get revenue, to get your clients to come to your office, you should have a space of your own. You should have an office of your own. At least even if you have one room or one particular place where you can sit and solicit clients, that is necessary. So for that, you'll have to invest or you'll have to take it on the rental basis. In either case of which you are paying a rent, that will be a fixed expense. Okay. So until and unless you pay that rent, you pay the deposit and get the place on the rental basis, and you start your office there, incur expenses. Worst comes to us, at least one boy you appoint over there to help you out with the errands. Then also the expenses are incurred, and that will help you to generate revenue. So when a client comes, he can see your office, he can see that you are having somebody to assist you. And in this way, your business will start. And as you grow, you can have more investment done. You can take a bigger office, you can have more clients, you can have more employees. And that is how the income grows or the business grows. So until unless you incur the expenses initially, it will not be possible for you to generate revenue. Expenses incurred to generate a specific amount of revenue in a period are matched against that revenue. For example, matching the cost of goods sold to the related sales revenue. That means the amount of manufacturing costs that you incur to manufacture the goods and sell the goods. That will help you to generate revenue. So the revenue that is generated is related to the cost. And then you can say that this revenue is coming from this cost, and that is the difference is the profit. Other expenses are allocated by systematic and rational procedures to the period in which the assets provide benefit, such as depreciation expense. Okay. Now, even the overhead expenses, as you must be doing in MA now, you must have learned that overhead expenses are allocated over different departments. Service departments, the expenditure is how it is allocated to the production departments and so on. So likewise, there will be certain expenses which are allocated over a period of time because it is not resulting in revenue in the current year. So it is deferred and it is incurred over a period of time. So you defer the expenses and you show it maybe over a period of 2 years or 3 years. Recognition of revenue and expense. Example is given. England Enterprises had the following transactions during the year. Earned revenues of 2,25,000 with 22,500 uncollected at year end. Purchased merchandise for 110,000, of which 36,200 is owed at year end, outstanding. All inventory purchase was sold during the year. Paid 3,500 for a 2-year insurance policy on the first day of business. Employees earned a total of 9,100 in salaries during the year. 1,000 of this amount is owed again at year end and will be paid on 2nd of January, year 2. Owners invested $30,000 in a business on January 2nd, year 1. The business borrowed $45,000 and the owners signed a 5-year 6% note. Calculate the year 1 net income for England. So the first thing that you will do is you will take earned revenues of 2,25,000. Now they are saying that 22,500 is uncollected. That means it is not received, but it is earned. So we will have to show it as full 2,25,000. Purchase merchandise for 110,000. That means you have purchased goods to be sold in the current year. So 110,000. So cost of goods sold is 1,10,000. So gross profit is coming to 1,15,000. Now expenses that you have paid actually. You have paid 3,500 for a 2-year insurance on the first day of business, out of which it's a 2-year business, 2-year insurance policy. So current year it is only half the amount. So 3,500 ka half the amount is 1,750. Okay. Then employees earned a total of 9,100 in salaries during the year. 1,000 of this amount is owed at the year end and will be paid on January 2nd. But since it is incurred in the current year, irrespective of whether you are paid or not paid, the full amount becomes an expenditure. Owners invested $30,000 in the business on January 2nd, year 1. And the business borrowed $45,000 and the owners signed a 5-year 6% loan. So borrowings of 45,000 is there. If you calculate now 6% on that 45,000, so 45,000 into 6% will give 2,700. So that interest expense has come here. Okay, so the total of the expenses 13,550. Net income is 1,01,450. That means 1,15,000 minus the expense, 1,01,450. Revenues earned by England during the year are recognized even if all cash is not collected. Why? Because we are going on the mercantile system. Mercantile system means accrual system. We have the cash system, we have got the mercantile system. We are going on the basis of mercantile system. Cost of goods sold consists of purchases of 1,10,000 of inventory. No inventory remains on hand. Entire items which are purchased are sold. Insurance expenses 3,500 for 2-year period. So we have classified that and divided that by 2 years, and each year we are getting 1,750. So they have explained the calculation of expense and income. Then we have gains and losses.
Sir,
Yeah.
in the illustration for like inventory, there was one more point given in the question. This 36,200 is over at year end.
Which one?
Second point, purchase merchandise for 110, of which 36,200 is owed at year end.
That is the purchases outstanding to suppliers. So this will come in the balance sheet as creditors. 36,200 is
Yes.
creditors. Coming to gains and losses. Gains are increases in equity and losses are decreases in equity resulting from transactions that are incidental to the ordinary course of business. Transactions resulting in gains or losses affect the company's financial position. Examples here given. Investments sold often result in gains and losses as the selling price frequently differs from the cost price. Property, plant and equipment is replaced or sold during the ordinary course of business. The replacement or sale will also result in gains or losses. So investment sold, property and plant sold, inventory sold, any type of asset which is sold will result in a profit or a loss. That is when you compare the book value of the asset with the selling price of the asset, that will be the difference which will give you the profit or the loss. Okay, so that is your calculation. Now, impairment of assets. Impairment of assets is decrease in the value of the assets. So decrease in the value of the assets. For example, we have not come yet to impairment, but still I'll just explain to you. Impairment means that when we are starting the, let us say we are having the book value of the asset as 4,50,000. So we purchased it at say $1 million, that is 10 lakhs. And over a period of time, 5,50,000 has been the accumulated depreciation. So 4,50,000 is a return on value. Some we are having these figures. So cost is given. That is $1 million. Accumulated depreciation we have got for whatever number of years, 5,50,000. And we have got the book value of the asset is 4,50,000. Book value, we call it as carrying value of the asset or carrying amount of the asset. Now, this book value represents, now this method of showing the details of PPE is actually called as the historical cost method of recording the PPE. Okay. Now, suppose you come to realize that this particular asset is not going to generate enough cash flows in the future, which will help us to recover that 4,50,000. Which will help us to recover the 4,50,000. That means the fair value of this particular asset is going to be less than 4,50,000. Samjho it is 4 lakhs. Let us assume that it is 4 lakhs. That means if I sell the asset now, I will get 4 lakhs. That is one meaning. Second, even if I use this asset now, in future, it will generate cash flows of only 4 lakhs. That means it is not going to help me to recover that 4,50,000. Okay. So the recovery amount is less. And the recovery amount is less than the carrying amount. We say that there is an impairment. Value of the asset has decreased. And this impairment may take place on account of several factors. It may take place on account of obsolescence. It may take place on account of that asset being worn out, having the asset being used, not used properly. So the wear and tear is more. So there can be different reasons for the impairment. But basically, the concept is what? Impairment means that you are not going to recover the value of the asset, the carrying amount of the asset with the help of future cash flows. Okay. So that is impairment. So this is also a loss for the business. So impairment of assets will be a loss. Then calculating gains or losses on disposal of fixed assets. To calculate a gain or loss on the disposal of a fixed asset, you compare the selling price and net book value of the asset. So suppose your selling price, this is the net book value of the asset or the carrying amount of the asset. Suppose the selling price that you are getting on this asset is 4,25,000. You compare this 4,25,000 with 4,50,000 and you say that 25,000 is a loss. It's a loss. Suppose your selling price is 4,55,000. 4,55,000. Then there is a gain of 5,000 because you're selling at a price higher than the carrying amount. Gain of 5,000. Okay. The net book value of the asset is the difference between the actual cost and the accumulated depreciation, as I've shown earlier. Actual cost of the asset minus accumulated depreciation. Land is never depreciated. The selling price is the price received in exchange for the asset. When the selling price of the asset exceeds the net book value, the selling price 4,55,000 is exceeding the book value of 4,50,000. Then there is a gain on the sale. And if the selling price is less, then there is a loss on sale. Okay. Calculation of gain or loss here. Actually, it is very simple. Ricky's Auto Shop purchased a piece of equipment for the shop at a cost of $50,000 on January 1st, year 1. The equipment had an estimated 5-year life and an estimated salvage value of $5,000. Ricky uses the straight line method of depreciation. On December 31st, year 3, Ricky has sold the equipment for $32,000. Calculate the gain or loss. So the actual cost of the asset is 50,000. And it is having a 5-year life. And an estimated value of salvage value of 5,000. That means 50,000 minus 5,000 salvage value divided by life of the asset 5 years. 45,000 divided by 5. So per year it is 9,000 per annum depreciation. Okay. Now on December 31st, year 3, meaning 3 years have passed. So 3 years have passed, total depreciation is 9 into 3, 27,000. So your accumulated depreciation is 27,000. So 50 minus 27, your net book value is 23,000. Okay. So annual straight line depreciation 50,000 minus 5,000 estimated salvage value divided by 5-year life 9,000. We have shown the same thing here. Calculate the gain or loss. We are selling the equipment for 32,000. So 32,000 and 23,000 we are comparing. Your book value is less than the selling price. Selling price is more. You are able to sell at a higher amount. So there is a gain on sale to the extent of 9,000. Okay. So this is how you calculate the gain or loss. All these things we have done in the 11th and 12th also. Operating income versus non-operating. Operating income consists of revenues, expenses, gains and losses relating to the primary revenue generating activities of the company. So whenever we say the operating income, it means all those activities which are involved in the purchase and sale of goods or manufacture and sale of goods. Non-operating income consists of revenues, expenses, gains and losses related to peripheral activities or transactions incidental to the primary activities of the company. That means the side activities, you can say, or the secondary activities. Now, for example, company is a manufacturing unit, or let us say we are talking about some company like Reliance Industries. Now, the main business of Reliance is in the FMCG sector. It is there in the construction business. It is there in the infrastructure business. Now, Reliance may be having a small property somewhere which has been let out on rental basis. I cannot say that that is the main business of Reliance. So that is the incidental business of Reliance. So the rent that is generated from the letting out of Reliance property is not an operating income. It is a non-operating income. So the main operating business of Reliance is manufacturing activity. So where your main activity is there, all the activities which are related to the main activity, that is called as the operating expenses and the operating income, which is not related to the main activity, which is related to the subsidiary activity or secondary activity. That is your secondary source of income or miscellaneous source of income. That is called as the non-operating income. Okay. So income from sale of goods is operating income. Income from interest received on investment is a non-operating income. Income from sale of asset, it's a non-operating income. Okay. Investments are often held for the purpose outside the primary revenue generating activities. So gains and losses associated with the sale of these assets are generally considered as a component of non-operating income. Okay. So that is your non-operating and operating income. Sales revenue is a part of operating income. Interest revenue is non-operating. Gain on sale of equipment, non-operating. Cost of goods sold is operating 1,56,000. Administrative expenses will be operating. Interest expense will be non-operating. It is finance. Selling expense, yes, it is related to manufacture and sale of goods. Income tax is non-operating. Loss on sale of investment, non-operating. So operating expenses, we have administrative expenses, selling expenses. Gain on sale of equipment, they have shown as actually the operating income, but it should, actually it should not come as a part of the operating income because they have taken the loss on sale of investment here as a non-operating. income or other income. So actually, this also should be coming here. Gain on sale of equipment, because that is not your main business now. It is not a part of your operating income. So that is one thing. Yes, Otis.
Sir, like over here, they have taken loss on sale of investments in non-operating income.
Yeah.
But gain on sale of equipment on operating, it may be like this because equipments are being used to manufacture the products, and like investment is completely different from the main business. So is it the reason that they have taken gain on sale of equipment in operating expense?
See, like that, I can argue that the loan that has been taken is for manufacturing activities.
Yeah. Okay.
And the interest expense also should be then, as per your definition, it should be classified as a part of operating expense.
Yes, sir.
So that is why normally it is gain on sale of equipment. See, anything that is related to the main business activity. Main business activity means manufacturing activity. When I'm talking about, it is not the asset that I'm talking about. It is a activity that I'm talking. So if it's a manufacturing activity, anything related to the manufacturing activity, administrative expenses, yes, because I need to prepare the accounts bill, I have to maintain the accounts of customers, accounts of suppliers. So for that, administration department is required. For promoting the sale of goods, which is my main activity, I will have to incur expenses. So all this will be related to the manufacturing and selling of goods.
Yes,
But
sir.
gain on sale of equipment, is it my main business to sell the equipment? No. So if it is not a part of my main business to sell equipments, then it is not an operating.
Yes, sir.
So that is, I think, it is an error which will be coming in the non-operating part. See, what they have said is what you have given you. They have said that it is included in the calculation because it is associated with the sale of an asset used in the operations. But normally it is not, because I can argue the same thing, that loan is taken for purchase of a machinery, which is required for the business. Or I can say that loan has been taken for working capital purpose. Now that you can't deny. So working capital purpose means it is required for business. Okay, so that argument, if you take, then everything will be operating. Okay. Expense recognition. Expense recognition, the timing of the expense recognition should be based on related revenues. In addition to being related to revenues, expense recognition affects the timing of the asset and a liability recognition. The recording of an expense will result in either the outflow of cash or the recognition of a liability for the payment of cash in the future. So when you record purchases, as you pointed out in the earlier example, that we have purchased some goods, but 36,000 is owed at the end of the year. So we recognize the expenditure, entire amount of expense of purchase is recognized, but a part of that is outstanding because it is not paid. So I show it as a liability. So either it will come as an expense in the profit and loss account, or it will come as a liability in the balance sheet. But in either case, we are recognizing the full amount. Okay. Cost of goods sold represents the cost associated with sale of inventory. Under a perpetual inventory system, the determination of cost of goods sold occurs throughout the year as such sale occurs. Alternatively, under a periodic inventory system, the determination of cost of goods sold occurs only at the end of the year after a physical count of inventory is complete. Journal entry for recording the cost of goods sold. That means if you are going to sell the goods, remember this, if you are going to sell the goods, there will be two journal entries passed. One is for the sale of goods. If it is a credit sale, it is debit the accounts receivable, credit the sales revenue. If it is a cash sale, debit the cash and credit the sales revenue. That is the first entry that you will pass for sales. Second entry you have to pass if the cost of the goods is given, and that is debit the cost of goods sold and credit the inventory, because inventory is being reduced. So to reduce the inventory, you have to credit the inventory account. Okay. Recognize loss in the current period. Under US GAAP, the write-down of inventory is usually reflected in the cost of goods sold unless the amount is material. That means if you are writing down, if you are reducing the value of the inventory, that you're writing down of inventory means that you're reducing the value of the inventory, then that should be by debiting the cost of goods sold and crediting the inventory because your inventory is going to reduce. In which case the loss should be identified separately in the income statement. IFRS does not specify where an inventory write-down should be reported on the income statement. That means there is no particular law as per IFRS where it is given that you have to record it under operating or non-operating income. It can be recorded anywhere, either in the operating section or in the non-operating section. But what they are saying, this is important. IFRS versus US GAAP, if they ask you, then this becomes a point. Because under US GAAP, it is reflected in the cost of goods sold. That means it comes as a part of operating expense. Right? But IFRS does not specify where the inventory write-down should be reported on the income statement. So as per IFRS, you can show it anywhere, either as a part of operating expense or as a part of non-operating expense. Reversal of inventory write-downs. Under US GAAP, reversal of inventory write-downs are prohibited. That means in the current year, you reduce the value of your stock. You reduce the value of your inventory. In the subsequent year, you feel that your value of the inventory has increased. So then can we change? Because we are having cost or market price, whichever is less. So in the first year, if the market price is less, I show it at market price. Second year, I say no, but now market price has increased. So I want to show it at cost. So can I change? The question is for MCQ, very important. As per US GAAP, the reversal of an old write-down cannot be done. It is prohibited. So once you reduce the, what does it mean? Once you reduce the value of the inventory, it is permanently reduced. It is not a temporary thing which can be reversed in the next year. It is permanently reduced. But IFRS allows the reversal of inventory write-downs for the subsequent recoveries. The reversal is limited to the amount of the original write-down and is recorded as a reduction of total inventory costs on the income statement in this period of reversal. Okay, so these 2 points you have to remember that first of all, how to recognize the loss of inventory. The loss of inventory is recognized in the current period as per GAAP, US GAAP under cost of goods sold, and under IFRS, there is no particular specification. Reversal of inventory loss as per US GAAP not allowed, it is prohibited. Whereas under the IFRS, it is allowed. Okay. So these 2 points, I'll just mark it here. That is important for MCQs. Operating expenses are incurred in the ordinary course of business and are related to the costs that are necessary to conduct the day-to-day operations of a business. Selling expenses and general and administrative expenses. So selling expenses represent the cost incurred in the generation of sales of a company. So for promoting the sales of the company, that is incurred. These costs include the marketing efforts associated with advertising of the product or service. Commissions on sales, freight out represents the transportation cost paid by the company to deliver the goods to the customers. So now, for example, if you are sending something by Amazon, then Amazon bears the cost of transporting the goods to wherever, whichever address you are saying. Okay, so it represents the transportation cost paid by the company to receive inventory from suppliers, is part of the cost of inventory purchased. The time of selling expense recognition is based on when the costs are incurred. Then you have general and administrative expenses which are incurred in support of companies' non-manufacturing operations. These non-manufacturing costs include utilities, supplies, salaries and wages of general and administrative personnel, rent, repairs and maintenance, and insurance. What about bad debt expense? Bad debt expense is necessary when the businesses allow sales on a credit basis. An analysis of receivables is necessary to estimate future credit losses associated with customers who will ultimately not pay the amounts owed. Expense recognition will be determined based on the review of accounts receivable and management's assessment of cash collection based on the analysis performed. Depreciation expense and amortization expense. Normally, this should be a part and parcel of depreciation expense is normally a part and parcel of cost of goods sold. Okay. So depreciation expense and amortization expense represent the allocation of the cost of long-term assets over the estimating period of benefits. Tangible long-term assets are depreciated, intangible assets are amortized. Both the processes are intended to recognize the benefit that extends across multiple accounting periods. Then we have interest expense that represents the cost of borrowing money. Interest on borrowings and the principal should be recorded in the period incurred to match properly against the current period revenues. Interest expense will be recorded at the end of each reporting period and is based on the principal balance of the note times the interest rate charged and then adjusted for the length of time the note is outstanding during the period. So you will be first calculating the amount of the principal value. Present value of all the future cash flows that will be discounted will get the principal value. And then every year you will be charging the interest on the basis of outstanding amount. Okay. Year-end interest accrued. Harris Hats borrows 1 lakh from Ammons Corporation on 1st February year 1. The note bears interest of 12%. And interest and principal are due February 1st, year 3. So 2 years ago. Determine the amount of interest expense Harris Hats must accrue at the end of year 1 and record appropriate entry for that. So 1 lakh is the principal, rate of interest is 12%. So if you see the date of taking the loan, it is February 1st. So 11 months in the first year. So 11 months in the first year. So it will be 1 lakh into 12%, but for 11 months into 11 by 12, adjustment for the length of time. The note is outstanding. So for 11,000, the amount is outstanding for the current year because the payment date is 1st February year 2. Or you can say 31st January year 2. That is the rate of payment of interest. So till then, at the end of the current year, only 11 months have passed. So 11 months interest has accrued. Okay, payment is made on 1st of February. So that is why interest expense account debit and credit the interest payable account because it's a liability. This will go to profit and loss account and this will go to balance sheet. Income tax expense. Income tax expense reported for the year includes current income tax payable plus any future tax due on the current year income statement minus tax currently due on current year income statement, items that will be deducted in future years. Now you have already done the income tax part, so you know what we are talking about here. We have got income tax expense, two things over here. Okay, so two things that you have over here is one is the expense of the current year, and the second is the expense which is deferred, which will be a deferred tax liability. Fine. So employee benefits. Employee benefits, employees receive compensation through hourly wages, salaries, bonuses, commissions, and eligibility for participation in stock compensation, plans and pensions. In addition to these forms of compensation, employees may be eligible for future compensated absences in the form of sick leave, vacation, and holiday permit. Employees are required to accrue liabilities associated with future absences when the following conditions exist. The employer's obligation to compensate employees for future absences is attributable to services already rendered by the employees. Obligation relates to rights that vest but are not contingent on an employee's future service or accumulate, which may be carried forward to one or more accounting periods subsequent to that in which term. So if you are having something like a sick leave, which you have not taken in the current year. It depends whether that sick leave is possible to carry forward in the next year. So suppose we are having 6 days of sick leave. You have taken only 2 of them. So whether 4 leaves can be carried forward to the next year. So employer's obligation to compensate employees for future absences is attributable to services already rendered. That means if you are absent in the future, it is in lieu of whatever services you have given now without being absent. The obligation relates to rights that vest and accumulate, but may be carried forward to one or more accounting periods. Payment of the compensation is probable. That means it is likely that the compensation will be paid. Amount can be reasonably estimated. So reasonably estimated amount means so we can calculate the amount that is payable. Under US GAAP, companies should recognize expenses and related liabilities for compensated absences in the year in which it has been earned by employees. If it is IFRS, under IFRS, short-term benefits expected to be settled within 12 months from the annual reporting period must be accrued. The amount of future paid absences must be accumulated and carried forward if the current period's entitlement is not used in full. So as per US GAAP, you have to finish it off in the same year in which it is earned. But as per IFRS, if it is not encashed in the same year, that can be carried forward. Sick pay benefits. Some companies only pay the sick pay if an illness occurs. Other companies may allow the employees to take time off related to accumulated sick pay, even if an employee is not ill. That means, in some cases, the sick leave can be strictly applied only when you are sick, not in any other case. But some companies, what they do is, suppose your casual leave is over, you have taken casual leave throughout the year and it has expired. Now you want to take a leave. Maybe there is a medical emergency or you are not feeling well, or somebody, you want to go out somewhere, or you want to take a break from work. You have been working continuously, you want to take a break, but you don't have casual leave. You don't have privilege leave. You have only sick leave. So can I take that sick leave? Answer is yes. If you have not expired that amount, you can take that. Okay. So even if an employee is not ill, you are allowed to take it. But under US GAAP, an employer is not required to accrue a liability for non-vesting accumulating rights to receive sick pay benefits. That means if it is not as per US GAAP, if you have not taken the advantage of the sick leave benefits, that cannot be encashed in the future years. Estimates of future sick pay are not reliable, and the cost of making and evaluating those estimates do not justify making an accrual. However, the employer should accrue sick pay benefits if the 4 criteria are met and the estimate is reliable. IFRS requires the accrual of sick pay benefits as services are rendered by the employees. Non-compensatory stock purchase plans. Basically, it is stock purchase plans that we are talking about. Under US GAAP, an employee stock purchase plan is non-compensatory if it meets all of the following requirements. Requirement number 1. Substantially, all full-time employees meeting limited employee qualifications may participate. Excluded are officers and employees owning a specific amount of the outstanding stock in the corporation. So if the people are already holding stock of the corporation, they are not included in this. Who are included? All the employees, all full-time employees meeting limited employee qualifications may participate. Second, stock is offered to eligible employees equally, but the plan may limit the total amount of shares that can be purchased. So whatever shares are there, that will be spread equally amongst all the employees. But there may be a plan where you are having maximum, that is a cap that has been put on the maximum number of shares that can be purchased. Third, the time permitted to exercise the rights is limited to a reasonable period. Time is restricted to a reasonable period. Any discount from the market price is no greater than would be a reasonable offer of stock to shareholders or others. So that means whatever is the discount offered from the market price is not greater than a reasonable offer price. That means it's not the discount is not more than what you would offer to any other person outside. Stock option plans that meet the requirements of a non-compensatory plan do not require the recognition of compensation expense by the sponsoring company. Plans that do not contain these characteristics are usually classified as compensatory plans and require the recognition of compensation expense. Now, can you tell me what is the meaning of this compensatory plan and non-compensatory plan? What have you understood? And what is this compensation expense that they are talking about? Require the recognition of compensation expenses. Tell me what is the meaning of this? What do you mean by compensating expenses? Compensation expenses to be recognized.
Sir, it may be that in the compensating expenses, the company had already planned to give the option for stock purchases to the employee. Like it was already planned, but in non-compensatory, it was not planned.
No. Then what is the meaning of compensation expense? What is the meaning of that? Why I'm asking you because we have not done these things in your accounts earlier. So you should have an idea as to what we are actually talking about because even these things like ESOPs are a part of this one. So employee stock option plan. That is the next thing. Okay, so what is actually the compensation expense that we are talking about?
Sir, is it something like the compensation that we pay to the employees, like the bonuses?
Yeah, see, it is like this. Normally, what happens is when you offer the stock option plan or the stock purchase plan, we tell the employees that there is a condition normally. And what is the condition? That condition is that if you are in the company continuously working for the company for the next 3 years, then you are eligible for certain stock options. Or if you help the company to reach a target profit level of so and so X amount at the end of 5 years, then you will be given this stock option plan. Okay, so you have the option to purchase the shares at a price which is discounted to the market price, which is up to you again whether you want to exercise the option or not. That is why it is called option plan. So it is up to you. Now, if you decide to exercise the plan, normally we go with the assumption that the employees are going to accept the option plan. So we say that it has been vested. Okay. Now it has been vested means that it has been confirmed or it has been assumed to be confirmed that so many employees are going to take up those plans or going to take up those shares at the end of a particular period. Now, if the condition, whatever may be the condition may be that the employee is going to continuously work for the company for the next 3 to 5 years. Or it may be that the company's sales target or profit target should reach a particular X amount at the end of 5 years. It ultimately means what? It ultimately means that the employees will be working to achieve that target. And if you're going to say that, the employees have achieved that target and give them that option, you have to compensate them. Normally, how do you compensate them? You compensate them through the concept of wages, isn't it? You compensate them for daily working for 8 hours. How do you compensate them? By paying wages. And how else do you compensate them? By paying bonus. If they are working good, it is being paid bonus. Now, the question is that if you are having this option plan or the purchase plan, that is their stock purchase plan, and at the end of that particular period, they purchase the plan, they accept the option of purchasing the shares at the agreed price. Then how will you show it in the books of accounts? You will show that it is similar to wages, that the employees have been compensated for working towards that goal. Okay, so like you are paying the wages, you have to recognize this as a compensation expense. Whatever is the value of those shares, that has to be spread over a period of 5 years. And show that as employees' compensation expense in the profit and loss. Because it will be an expenditure related to the day-to-day activities of the business. Suddenly, you cannot show at the end of 5 years that, okay, shares are being offered to the employee. From where you are offering, why you are offering. That question comes. Okay, so that has to be spread over. So that is what US GAAP says. Under IFRS, employee stock purchase plans and stock options are generally considered to be compensated. That means you will have to show the expense on a year-to-year basis. So now in this particular date, as I told you, vesting is going to come. So a number of concepts or new definitions are there. Compensatory stock options and stock purchase plans require the recognition of the compensation expense. Under the fair value method, total compensation expense is measured by applying an acceptable fair value pricing model, such as the Black and Scholes option pricing model. This compensation expense calculated on the grant date of the options is allocated over the service period in accordance with the matching principle. Because just as I told you, all of a sudden you cannot show that employees have gained, the target of the profit that we had desired and set for them in the 5th year, because they have not gained it in the 5th year, they have gained it over a period of 5 years. So you will have to show that, okay, for the work of the employees, we are rewarding them. It is like a bonus to them. We are rewarding them. So there is a compensation that is payable to the employees. That compensation is to be shown on a year-to-year basis. Okay. So the service period is the vesting period, which is the time gap between the grant date and the vesting. So today, if I tell you that if you are going to remain with the company, work with the company continuously, non-stop for the next 5 years, I will be granting you additional shares on the 5th year last day. And today what has happened is, today's date is what? This 14th of February. So where I enter into an agreement with you and you sign the agreement and for this particular option, that particular date is called as a grant. Okay. So the grant has been issued today. I have made this offer today and you have accepted this offer. So that is a grant date. Okay. So what is the exercise price? Exercise price is the price at which the underlying stock can be purchased pursuant to the option contract. So the price is fixed in advance that at the end of 5 years, you can purchase the shares at so and so price. Of course, that price can be revised on the basis of what changes are taking place in the market. Exercise date. The date by which the option holder must use the option to purchase the underlying shares of stock. Okay, that I'll come to. Fair value of the option determined by the economic pricing model like the Black and Scholes model. Grant date is the date the option is issued. Vesting period is the period over which the employee has to perform services in order to earn the right to exercise the options. So if you are working with, I told you, if you are working with the company for 5 years, so that 5 years becomes a vesting period. If at the end of 5 years, you have to achieve a target of, my company should be touching a target of $500 million. Then over the period of 5 years, that 5 years period is the vesting period. At the end of 5 years, the date that comes, that is a vesting date. The vesting date gives you the right to exercise or not to exercise the option. Right? From that date, you enjoy the right to exercise or not to exercise the option for a period of time. Like for instance, let us say 1st February, or let us say 14th February, 2024. And I give you 3 years time. So 24 to 25, 25 to 26, 26 to 27, 13th February, 2027. This is the vesting date. On this date, you become eligible to exercise your right to purchase the shares or not to purchase the shares. But now again, I tell you, you don't have indefinite period of time. Ki kabhi bhi when you can purchase. Anytime you can purchase. No. Here again, I fix the date. Is 13th February you become eligible. That is a vesting date. But you can exercise your option maximum till 31st March 2027. So I give you just 1 month's time. Okay, so within this 1.5 months, you have to exercise. So that is your exercise period. Your vesting period is from 14th Feb to 13th Feb 2027. Your exercise period is from 13th Feb 27 to 31st March 27. Now, some companies may give you 1 year also. Some companies may give you 6 months also. So, from what date till what date you can exercise the option. Now, between 14th Feb and 13th Feb, you can't exercise the option. Between 14th Feb 24 and 13th Feb 27, you have to perform what is to be expected of you. Not leaving the company for 3 years, you have to ensure that you are working with the company for 3 years. If they say that at the end of 3 years, my company should have a $3 million value. So at the end of 13th Feb, your company should have a $3 million value. So like that, the condition has to be satisfied. The performance of the services should be there during that period. That is the vesting period. So from year to year, this is the vesting period. Okay. Service period. The period over which the compensation expense is recognized. That is a period in which the employee performs the service. That is called a service period. But actually, service period and vesting period are one and the same. They have just given it as an additional concept, but it is one and the same. Because if you are told that within 3 years you have to generate the value of the income, the value of the company should be $3 million. Then during those 3 years only, your service will be counted for. That is the service period. The vesting period and service period are one and the same. Okay. So these are all your concepts. So are you clear with all these points? Especially grant date, vesting date, exercise date. Okay. Exercise period, fair value of the option, all these points, all these concepts, you have to be familiar with. Okay. Let us take an example. On 1st January year 1, ABC company granted options exercisable after December 31st year 2 to purchase 10,000 shares of $5 per common stock for $25 per share. On the grant date, that is 1st of Jan year one. That is a grant date. The market price of the stock was $20 per share. Using an acceptable valuation model, the options had a total fair value of $50,000. The options are to serve as compensation for services during year one and year two. Prepare the journal entries to account for the stock. What they have said is that 2 years are given to you, year one and year two. What is the grant date? The grant date is January 1st, year one. Okay. What is the vesting period? 1st January, year one, up to December 31st, year two. That is a vesting period. Okay. What is the vesting date? December 31st, year two is the vesting. Okay. Now, what is the fair value of the shares? Fair value of the shares is $50,000. Now, what you have to know is that if the employees complete those 2 years, satisfy the condition, then you are going to give them 10,000 shares, 10,000 shares of $5 per common. And the total fair value of the shares is $50,000. Now, at what price you are going to give them? The price is 10,000 shares, you are going to give them at $25 per share. This is the price at which you are going. 10,000 shares at $25 per share. But since the option is having a total fair value of 50,000, the compensation expense that you are going to show cannot exceed 50,000. Matlab, whatever you are showing as expense or bonus, like expenditure which is payable to the employees over a period of 2 years, should not be more than 50,000. Now, since it is period of 2 years, I divide that 50,000 by 2. 25,000 I have to show in the first year, 25,000 I have to show in the second. So my journal entry for the first year will be debit compensation expense, credit additional paid in capital. EPIC, you remember EPIC, additional paid in capital. So compensation expense debit, credit additional paid in capital. That means we are keeping aside this much amount of shares, having a fair value of 25,000. And why we are keeping this aside? We are showing that this is the amount that is payable to the employees. So suppose like I'm saying wages are payable to the employees. I said debit wages. So here instead of debiting wages, I'm debiting compensation expense because it is related to the option. This compensation expense. Again, second year, I will be passing the same entry, debit compensation expense credit, EPIC, that is additional paid in capital. On January 1st, year 3, all options are exercised because vesting date was December 31st, year 2, last date of year. Whatever condition has to be satisfied. Whatever condition you have put, it should be satisfied by December 31st, year 2. So from that date onwards, or from the next date, that is January 1st, year 3, your exercise period starts. Now, what they are saying is that the exercise has taken place on all options are exercised on 1st January. Okay, and the market price of the stock was $35 per share. We are not concerned with that. We are not concerned with $35. What we are concerned with? Cash that we are going to receive because all the shareholders are going to, all the employees are going to exercise the option. How many shares? 10,000 shares. What is the price at which we have promised them? $25. So 10,000 into 25. This is what we have promised them. That comes to 2,50,000. Okay. Now 10,000. What can be transferred to share capital account? Only the nominal value, only the par value, only the face value. $25 is not the face value. Kitna hai face value? $5. How many shares? 10,000. So 10,000 into 5. ये जो par value है, face value, only that much can be transferred to share capital. So credit common stock 50,000 here. Okay, now. Next is additional paid in capital in excess of par value. In excess of par value, you are having this entire 2,50,000 coming in. So this 2,50,000 is coming there. So now the difference is your additional paid in capital of 50,000, which you have shown already as expense over there. So you made a provision in these 2 years. You made a provision कि इतना देना पड़ेगा. This much amount we may have to pay as expenditure to the employees. So accordingly, your compensation expense was debited. और उसका provision किया था by EPIC, crediting EPIC, additional paid in capital. Now that provision is to be cancelled because we are actually offering them shares. So provision cancel कैसे करेंगे? How to cancel? Credit is to be cancelled, so we debit that account. So additional paid in capital is debited. So debited. तो वो cancel हो गया. 25, 25, 50 will get cancelled against this 50. So this 250 plus 50, 250 plus 50 are generated tax. See whether you have understood. Take your time. 2 minutes to spend. See whether it is possible for you to understand. Yes, Krish, have you understood?
Yes, sir.
One thing that I noticed, Krish, in the last session, don't laugh, but I noticed one thing. In the last session, when I was doing CMA, last 10 minutes, you are checking my status. Because the time that was, that was recorded there was the time when I was actually teaching you CMA. And it was 10 minutes before my lecture concluded. So now I feel, when you are going offline, I mean, when your camera is off, I feel that you are doing some multitasking there. And I was told by some of your section B students that there is a gang for checking the status. That means some students are stalkers, some students are fans. They are regularly in touch as to what status I put up. So are you one of them? One of the gang members?
No, sir.
So this example has been understood. This is the same thing that we'll be doing for ESOPs also, that is employee stock option. Now, employee stock option may and stock appreciation rights. What is the difference? SARs. Employee stock options may a stock purchase plan may. What happens is an agreement is made that if you satisfy certain conditions, if you fulfill certain conditions, then in that case, you are eligible to purchase additional shares of a company at a reasonable price, which is less than the market price. So you get a benefit out of. Stock appreciation rights में क्या होता है कि you are not getting any shares, but you are going to get the difference in the market price of the share and the exercise price. So whatever appreciation has taken place in the value of the stock means shares. Whatever appreciation has taken place in the value of the stock, that appreciation, that difference will be given in cash. Okay. So a stock appreciation right entitles an employee to receive an amount, not shares, an amount equal to the excess of the market price of the stock over the exercise date over a predetermined amount, usually the market price at grant date. So the difference between the market price of the grant date and the market price of the vesting date, that is exercise date, obviously it must have appreciated, no? So whatever is the difference. Now, for example, market price on the grant date was $25 per share. And on the exercise date, it has gone up to $45. So $20 appreciation has taken place. So that $20 per share into number of shares that you are offering to accept, that will be paid to you in cash. So you are not getting shares. That much number of shares, whatever is the difference, that you will be getting in cash. Okay, so understood the difference between a purchase plan or an option plan and the SARs, that is the difference. No shares are given in SARs, you are given only the difference in cash. Okay, the excess multiplied by the number of rights outstanding is recorded as compensation expense and a liability. So that $20 difference into number of shares that you offered to accept, that is calculated and given as a compensation expense. Compensation expense for stock appreciation rights outstanding must be adjusted annually to account for changes in the market price of the stock. Unlike the stock options, stock appreciation rights do not require the employee to make a cash payment. On January 1st, year one, Loud Corporation granted Mart its president 10,000 stock appreciation rights, expiring on Jan 3rd, year 4. Upon exercise, Not may receive cash for the excess of market price of the stock on that date over the market price on the grant date. And the service period runs for 2 years. Market prices were as follows. January 1st, that is grant date, it was 30. December 31st, year 1, it was 45. So in first year, there is an appreciation of $15. December 31st, year 2, it has increased to, it has gone to 40. So there is a difference again on December, from December 31st, year 2 to 31st January to 1st January, year 1. That is by $10. Okay. From year 1 to year 2, actually there is a decrease by $5. But if you see the net decrease from 30 to 40, there is a net decrease of $10. Okay. So prepare the journal entries. Not accessed all the stock appreciation rights on January 2nd, year 3, when the market value was still $40. Prepare the journal entries for the year. Now, first year calculation. Market price as on December 31st, year 1 is 45. Okay, that is this figure. And on grant date, when you originally accepted the agreement, it was $30. So difference of appreciation is $15 per share. So that is your $15 appreciation. Number of stock outstanding, how much he has accepted? 10,000 stock. So 10,000 into 15, this amount is 1,50,000. Okay. Now, compensation for the first year, since it is only for 2 years, compensation for the first year, it is half of 1,50,000, so 75,000. So compensation expense debit, credit liability for SAR plan 75,000. A liability account is credited because Mott will receive cash. He is not going to pay anything, he is going to receive cash. Otherwise, paid in capital would be credited if the stock was to be issued. Now we are not issuing the stock. If the stock was credited, earlier what we did, debit compensation expense, credit the EPIC. Because we were issuing the shares, we were issuing the stock. Now stock is not there in the picture. What we are going to give is a cash. Means there is a liability to pay. So it will be credit liability for SAR plan. Okay. Now this is in the first year. The second year, what happens is that $40 is the market price. And if you go to see, $30 is the grant date price. So actual difference is only 10. And therefore the value should be only 1 lakh. Now listen to this. Listen to this. 1 lakh, if it was there, then it should have been 50,000 in the first year, and 50,000 in the second year. Now, first year story is already over. We can't change that. So in the second year, I should make a provision of 50,000. Correct? But out of that 50,000, 25,000 excess we have already charged in the first year. So now I will charge only 25,000. Okay. So now it is debit compensation expense, credit liability only 25,000. So 1 lakh is to be there, but already 75,000 the credit we have already given. So 1 lakh minus 75, 25,000 is maximum amount I can provide for liability now. Okay. So that is how you get that 25,000. So when the stock appreciation rights are exercised, the liability account will be cancelled. Cash is going out, credit cash 1 lakh. Now go through this example and see if you have understood. First, you take the difference between the opening balance and the year-end balance. 1,50,000 are there, spread it over 2 years, 75, 75. Second year, again you calculate opening balance and the closing balance of the second year. So 40 and 30, 10 are there. So 10 into 10,000 is 1 lakh. 1 lakh means you have already made a provision of 75,000. So current year we can make a maximum provision of 25,000. Okay.
Sir,
Yeah.
in this question, like it is given the expiry of the option is supposed to be in the year 4. So
Yeah.
like if he would have taken decision to exercise the option in the 4th year, so then also it must be same on them because it is year 4.
We'll require the details also on the 4th year as to what is going to be the market value, the fair value as on December 31st. We'll be given the additional information.
Okay. But it will be
Yeah.
for 2 years only. Then service period will be of 2 years.
Since he is exercising the rights from at the end of second year, it will be completing in the second year. only.
Okay.
SAR calculations are understood. So we'll stop here for today. We'll continue tomorrow, same time, 6 o'clock. Okay. Just go through the examples again. Sarka, you have to go through because these things are absolutely new for you, and the terms, the concepts, grant date, vesting date, exercise period, vesting period, all these things are important. Okay. See you tomorrow.